Hi everyone, this is your Principal of Management class. Today's topic will cover rest part of financial statement. In our previous class, we discussed two types of financial statement, that is income statement and balance sheet. Today I will discuss three more types. They are statement of change in equity, statement of cash flow, and noted to financial statement. So, the first type will be discussed here is statement of change in equity. Statement of change in equity are one of the financial statements that show the shareholders' contribution and movement in equity and equity balance at the end of the accounting period. Information that shows in these statements include classification of share capital, total share capital, retained earning, dividend payment, and other related state reserves. You should remember that the statement of change in equities the is the result of the income statement and balance sheet. Basically, if the income statement and balance sheets are correctly prepared, the statement of change in equity would be corrected too. An example is shown in the PDF file sent to you. Go through it. The second one is the cash flow statement. The cash flow statement measures how well a company generates cash to pay its debt obligations, fund its operating expenses, and fund investments. The cash flow statements complement the balance sheet and income statement. There are three sections in this statement. They are cash flow from the operation, cash flow from investing, and cash flow from financing activities. For example, cash flow from operating activities helps users to know how much cash an entity generates from the operation. In general, the information will be shown based on the method of cash flow that the entity prepares. It includes direct and indirect method. The cash flow statement allow investor to understand how a company's operations are running, whereas its money is coming from and how much money is being spent. It also provides insight as to whether a company is on a solid financial footing. There is no formula for calculating a cash flow statement, but instead it contains three sections that report the cash flow for the various activities that a company has used its cash. Those three components of the cash flow statements are listed below. The first component of cash flow statement is operating activities. The operating activities on the CFS, that is cash flow statement, includes any source and uses of cash flow from running and the business and selling its product or services. Cash from operations include any changes made in cash, accounts receivable, depreciation, inventory, and accounts payable. These transactions also include wages, income tax payment, interest payment, rent, and cash received from the sale of a product or service. Investment activities includes any source and uses of cash from a company's investment into the long-term future of the company. A purchase or sale of an asset, loans made to vendors or received from customers, or any payments related to a merger or acquisition is included in this category. Also, purchases of fixed assets such as property, plant, and equipment are included in this section. In short, changes in equipment, assets, or investment relate to cash from the investing. The last activities is financing activities. Cash from financing activities includes the sources of cash from investor or bank, as well as the users of cash paid to shareholders. Financing activities include debt insurance, equity insurance, stock repurchase, loans, dividend paid, and repayment of debt. The cash flow statement reconciles the income statement with the balance sheet in three major business activities. The third type of financial statement is noted to financial statement. It is the important statement that most people forget about. It is the mandatory requirement by IFRS, that is Indian Forest Reserve Service, that entity has to disclose all information that matters to financial statement and helps users to have a better understanding. Note, or sometimes call disclosure detail, the financial information related to the specific accounts. For example, in the balance sheet, you will see the balance or fixed asset, but detailed information of this fixed asset is included not in the statement of financial position. If the users want to learn more about those fixed assets, they need to go to note to those fixed assets. There are certain limitations present in financial statements. Although financial statements provide a wealth of information on a company, they do have limitations. The statements are open to interpolation, and as a result, investors often draw vastly different conclusions about a company's financial performance. For example, some investor might want stock repurchases while other investors might prefer to see that money invested in long-term assets. A company's debt level might be fine for one investor while another might have concern about the level of debt for the company. When analyzing financial statements, it's important to compare multiple periods to determine if there are any trends as well as compare the company's result its peers in the same industry. In there are certain PDF file which is attached with this PPT, where two examples are shown on um, change of change of equity, and the second, that is cash flow statement, which will be um, clearly given to you. Go through it, and if you have any doubt, consider me. Thank you.